everyone. My name is Carrie Barnes, and I am the Chapter Administrator, Executive Director of Building Managers International. And today we're here to talk from an insurance perspective on the devastation that happened in Surfside, Florida. Champlain Towers South collapse. We first want to start with a real quick disclaimer. We're not here to point fingers at anybody. We're not here to judge. This is a very soft topic, and it's hit our community, our industry really hard. What we have to do now is take what has happened and learn from it. And we're trying to do that from an insurance perspective here today. Robert Mitchell is with me. He is the owner and president of Mitchell Insurance Services in Pinellas, Florida. And we will be discussing some scenarios. We're playing out scenarios, things that could happen, may have happened. This is all just us trying to kind of feel out how the claim may play out and all of the different pieces that are involved with the claim. This is not us saying this is what's going to happen. So just want to put that out there. This is strictly our opinions. Robert, did you want to add to that disclaimer in any way?
No, I mean, other than the fact that, in terms of how claims ultimately unfold, it's up to the carrier and the adjuster and how they interpret the policy and interpret the specific situation of the events. Anything that we discuss here is just simply based off of what we do know about the collapse. And obviously, this is subject to change as more information comes out. And these are hypothetical situations that we can use to apply to the insurance analysis to specific associations in the area.
Well said, yeah. So I want to start by saying there's a huge misconception with insurance that people think that when they have a claim, they have control over it. And that is not true. When you sign an insurance policy, you're basically signing the handling of the claim, the decisions of the claim over to the insurance company. Am I correct?
Well, when you have a claim, there are duties and responsibilities that the insured or the client ultimately undertakes by signing the insurance contract. So an insurance contract is essentially an agreement between you, the customer, and the insurance company that under a certain set of events, they will be responsible to reimburse you. And as part of your responsibility, it's your job to comply with certain conditions. And so when you have a claim scenario, there are responsibilities that the insured has to undertake. But ultimately, you're correct in the sense that the insurance companies are the ones that will ultimately determine what coverage applies and how much is to be paid out. If you disagree with what the insurance company's analysis is, there are remedies to that through litigation or outside third-party adjusters.
Have you, I guess this is a good way to start it, is like basically whenever something happens, when any type of big claim happens, especially when it's in the media like it is, you'll see from insurance companies, they'll start putting out all kinds of notices to their agents. What are you guys seeing as far as what the insurance companies are how are they responding to this? Are there changes in the guidelines yet? Because I kind of feel like there might be.
So we're already in a difficult market from an insurance perspective here in Florida. We're in what's called a hard market right now, which is a time frame where insurance companies are reducing coverages and the cost of coverages that are available are at a level that are higher than they have been in previous years. The reason why we're in this current market environment is twofold. Number one, we've just had more storms over the last few years.
Yeah.
The cost of claims have gone up, and in Florida, we have a litigious environment. So the litigated claims that insurance companies are having to address have gone up tenfold over the course of the last 10 years. And so insurance is a for-profit business. And when insurance companies aren't making money, one of the remedies to increase their profit is to adjust their pricing models and the cost of insurance that's afforded to the customer. And so what this has done is essentially thrown a hand grenade into an already difficult property market. The response that we're seeing from insurance companies, initially, we're starting to see increased scrutiny over the underwriting of buildings that are older than 20 years old, and not just on the property side, but also on the liability side. So, we're starting to see our D&O carriers request information that basically pertains to any structural issues that the association may have. Have there been any assessments or requests for assessments levied over $1 million? Have you done any structural repairs over the course of the last 3 or 5 years? If you haven't done any structural repairs, do you have any in the works? One of our other carriers that we saw from the property side, they've already stated that they're not going to be insuring anything that's older than year 2000 construction. And as part of their underwriting submission, they want to see 1 year's worth of board meeting minutes to determine whether or not there's been any discussion on structural issues or assessments or anything that relates to the integrity of the building.
So you guys are already having to reach out to these board members, to your insureds, and say, look, be ready, because we either need this information now or we're going to be sending some stuff out. Is that kind of what's going on?
Correct.
Or is this as it renews, it's coming up?
So we're getting emails from our D&O carriers for October and November renewals asking about the structural integrity of the building and underwriting questions about that. Yeah, it's starting to come hard and fast. The effects are going to be long lasting on this from an insurance perspective. What I'm going to predict is that the availability of coverage for older associations, especially older coastal associations, is going to be limited. And I foresee a situation where a lot of associations are going to have to make a decision as to whether or not they want to go back to Citizens. And Citizens does have the backing of the state, but their policy forms do not offer the comprehensive coverage that some of the private market carriers offer. Or you're going to have to go to an E&S market and roll the dice with them, which is not necessarily a bad thing, but the outcome of this is going to be older associations are going to have to prove themselves to the insurance underwriters. And what we're also seeing too, I didn't mention this, is the underwriters are starting to ask for the last building inspection or the last engineering report that was done. And if the association hasn't had one done in 5 to 10 years, they're going to require one be done in order to consider them from an underwriting perspective.
5 to 10 years. Okay, that's a big one. Because they weren't requiring anything like that before, were they? They were just doing the appraisals, looking at the appraisals?
No, so a standard underwriting process from the property perspective, they want to know, when the building was built, how the roof is constructed, when the roof was last updated. And so in general, they need wind mitigation forms, an updated appraisal, and a few other and a loss run report to see what the claims history was. But those are the days of old. Now we're going to have to basically prove to the underwriters that there aren't any issues with the building in order for them to consider us.
And there's going to be a discussion that, some of this stuff's going to lead into engineering questions, and and also there's association legal questions, and we're going to try to have our different associates on to talk about these things. So today we're just focusing on insurance because this thing is all over the place of how it affects our industry. All right, my next question to you would be then, can the insurance company force us to make any unnecessary repairs that do not have anything to do with structural integrity of the building? For an example, can an insurance company come out and say, your parking lot is looking really shabby, you need to reseal it, or you need to fix the holes in the parking lot, or you need to fix the bulking up from the tree roots of the concrete sidewalk, it's a trip and fall, that kind of thing. How do they address those types of issues?
Oh, absolutely. So anytime an insurance company writes a policy, specifically a property policy, they send out an inspector to make sure that everything that was on the written applications complies with what they see out at the property. The inspector also identifies any areas where there could be an increased claim potential. So in your example of a parking lot, we have insurance companies all the time require that associations repair or resurface their parking lots because, let's say, a tree root is upended the concrete, that's a tripping hazard, that's a liability hazard. So insurance companies, they're a private business, they're a for-profit business. They don't have a duty to insure you. It's a mutual contract. And if they see something that they don't like, or they deem an increased risk or an increased hazard that could potentially cost them money, they can force you to comply with their insurance inspection recommendations. Typically, they give you 30 days for compliance. And if you don't comply within 30 days, they'll send you a notice of cancellation, and then you'll be forced to find coverage in the secondary market. So once again, I mean, the thing about insurance that, everyone needs to understand is they have no responsibility to you. You have a responsibility and a duty to them to make sure that your property is in the best situation possible to not have a claim arise, or if a claim does arise, to mitigate the damage or the extent of the damage that occurs at the property.
Kind of goes back to when you're looking at the renewal and you're reaching out to different companies to offer proposals on the renewal policies. What the board members and managers may not be aware of is there's a lot of them out there, but there's little things that tick off that say, okay, well, they haven't had the roof updated this month, so this market's out. This is, so you do your own little, as an agent, you're doing your own little checklist and saying you don't fit into this. So and then every once in a while you'll come across something, they'll say, well, we'll look at it, as long as we'll write the coverage or we'll renew the coverage, but before we do, they need to get these items done. I guess that kind of thing.
Absolutely. So the way insurance companies works, you might have 3 companies that do this, the same type of insurance. Let's say they'll do property insurance for condo associations in the state of Florida, but each one of those companies, they may have a different emphasis on specific underwriting requirements or underwriting guidelines. So one company doesn't want to do coastal, the other company does wind only on the coast. And so they have different underwriting strategies, different underwriting models, and they place an higher emphasis on different aspects of the risk. So, maybe one company says, well, we're okay with older buildings as long as the roof has been updated within the last 3 years. One company says, no, we're not going to do anything that's older than the year 2010. And so we, as your independent agent, we shop the market for you. We understand the different underwriting requirements of the different carriers. And then we go out, take your specific association risk profile and submit that to the underwriters and let them, properly analyze the risk and price it accordingly to them. And so what we're seeing right now, it was already getting difficult, but the most important thing for associations, I guess, from an insurance purchasing perspective, don't defer your maintenance. And if you're planning to get your roofs done, just go ahead and start doing it, because roofs that are older than 15 years, a lot of carriers are completely writing you off before you even get to the door. Then if they do write you, they're not going to give you a full replacement cost on the claim settlement. If you have roof damage, they're going to do what's called actual cash value, which essentially is taking the remaining life of the roof and paying you that amount versus the full actual replacement cost of the roof. So
which can be a hard hit.
Which can be a hard hit. So what associations, when they ask me what you can do to help mitigate, increased insurance cost, it's number one, don't defer your maintenance, because deferred maintenance always leads to issues down the road. Number two, if you don't have updated roofs and you are planning to do it, go ahead and start getting the wheels in motion.
All right, let's get to the fun part of this. And that's, I don't want to be disrespectful, but I mean, when you're in the insurance industry and you work so hard at reading coverages and understanding coverages, Robert specializes in community associations, so he knows them inside and out. And when a claim like this occurs, we're always kind of sitting on the edge of our seat saying, how is this going to play out? Which policy is going to be triggered? So there's a lot of different policies involved that could kick in. I'm going to name some of these, and you might want to add to the list. I don't know, but I'm thinking association liability, the master association policy, because this was the South Tower of a North and East association. I don't know if there was a master to all of that. We do know that the South Tower was its own association, but if there's a whole other master policy involved, that's even more insurance involved. Then you have your association's directors and officers liability. You have your association's property policy. You have the unit owners condo policies, tenant policies, if any, renters policies. And then you have your builder, developer, architects, and engineers who did the original construction on the building. And then on top of all of that, any service contractor that's probably ever stepped foot on the property is now probably going back and checking all their documentation of what they did while they were there. Mm-hmm. So we don't know how it's gonna, like, we're just playing with this to see, kind of give an idea of what we think is gonna happen. In your opinion, can you tell us, let's just look at it, if they come back and say that the board did everything they were supposed to do, and what was delaying everything was a money problem, what could, let's just say, let's take directors and officers liability out of it. How do you see these policies being triggered?
Okay, so here's what we know. This is all public record, and let me circle back. So my wife is also in the insurance industry, and we watch Good Morning America in the mornings while we're getting ready for work. And when we turn the TV on, the first thing we saw the day that this occurred was Good Morning America discussing the condo collapse. And outside of just the sheer terror of what happened, it obviously hit very close to home for both of us, because number one, I work with community associations on a daily basis, but she also does insurance for property in the state of Florida. My first thought was, I'm grateful I'm not the agent. I feel terrible for who the agent is, and I feel terrible for the association board and the property management company, if they have a property management company that works with that association. Because when you have the media and the court of public opinion, regardless of any contract or policy structure that's in place, you can essentially throw that out the window, because how the policy is supposed to respond versus the way an argument will be formed as to why it should respond are two different things. And so when we saw the condo collapse, like once the initial shock eroded, we started going into coverage discussions and playing out hypothetical situations. Is this covered? Is this covered? Well, if this happened, it wouldn't be covered. So here's how I see things potentially playing out. Let's start with the property coverage, because that is the one that is on the forefront. What we know, there was a $30 million policy in place. Whether or not that's going to be sufficient is still to be determined. Condo associations are required to get an appraisal every 36 months by state statute. What we know about construction costs over the course of 3 years, it's a lot of times it's increasing rather than decreasing. Whether it's the cost of labor, whether it's the cost of materials. Not too long ago, I did a kind of an analysis on an appraisal, and what I saw was that the replacement cost was increasing roughly 1.5% or 2% each year. So if you haven't had an appraisal done in 3 years, theoretically you could be 6% overall increase in your replacement cost, give or take. These are not specific numbers, but in general terms. So if they hadn't had an appraisal done in 36 months, then we could reasonably assume that if the policy is triggered, the $30 million would be insufficient. And that's not building in the fact that this was a building that was built in the 1980s. Building codes have changed, and so ordinance and law coverage would be triggered. What we don't know there is what those limits were. As it pertains specifically to the coverage, where I see the policy responding, on a standard ISO special form policy, you do have coverage for what they call building collapse or collapse, and that's defined as an abrupt falling down or caving in a building. Now, where you could potentially see issues, or where the insurance company could potentially try to take a stand, not days after the building collapsed, there was multiple lawsuits that were filed, and a few of the lawsuits were pertaining to construction defect. Now, the building was built in 1980. I don't know what the specific basis of the litigation is, but if alleging construction defect is not a covered cause of loss on the special form policy. Now, I think that they're going to run into some issues with that. And from the legal standpoint, what we know about the building is there were issues or design issues with the swimming pool area. Where all this derived from, and we still don't know specifically where the collapse occurred, but what we do know is that there were major structural issues that were resulting from water pooling where the pool area was above the garage.
No
And
proper drainage, yeah.
So theoretically, what was happening is whenever it rained or whenever there was a storm, there was water pooling in the deck area, which led to water intrusion into the concrete structure. The concrete was bowing, the steel and rebar was starting to get exposed and rusting out. And so in theory, construction defect isn't a covered cause of loss. So the insurance company could potentially try to deny the claim based off construction defect. Now, the other issue that we run into, we know that the association has been aware of the structural issues for a number of years now. It was out there. Yeah, 3 years. I think it was back in April, the board president sent out a letter to membership stating that we need to do this $15 million assessment in order to get the building back up and running the way it needs to be up and running.
And the question is that the first time they've notified the members? That's going to be key, right?
What we also know is that this was an issue dating back to 1996. So in 1996, there was repair work done on a similar issue in similar areas of the building. Gross negligence is theoretically not covered under standard property policy. Wear and tear is not covered under standard property policy. I don't see this happening because I think the reputational harm to the insurance company would be far greater than the $30 million payout.
Yeah.
So what I potentially see happening is them just cutting a check for the full policy limits and trying to just intake the loss. Reinsurance will probably apply there, but if they wanted to, and if they were of the mind to do so, they could potentially try to deny the claim based off of construction defect or gross negligence. I don't see it happening, but it's an interesting thing to play out. If it wasn't such a publicized case, and so let's look at it from a smaller perspective. Let's say it's not a full condo collapse. Let's say it's, some other minor issues. Let's say, you have, windows or something that's going on that, isn't all over the news. Wear and tear, construction defect, those are things that aren't covered under your property insurance policy. And like I said, if it's a situation where it's not as well publicized and it's a smaller issue, insurance companies, are rightly able to deny claims on those bases.
This is really for unit owners and board members to understand. The policy, if the property policy does cut a check, it's going to cut a check to the association itself.
Right.
The association would then be responsible for divvying out to the unit owners. Because let's just say they dissolve, or I don't know what could happen, but technically the building's gone. There's no association. It's only on paper. So they would just divvy out checks to the unit owners. And then I see the unit owners policy coverage going, okay, well, first of all, we might pay out, but we're going to turn on subrogate. Don't you see that? Like they'll say, if we pay anything, we're going to subrogate it against whoever at the end ends up being at fault, whether it's the board, the association, or the builders.
Yeah. So the unit owners policy, there's provisions to where they're not, they're no longer allowed to subrogate against association policies, but you get into a gray area because it's such a, an outstanding or phenomenal event.
Yeah.
The most important thing that you need to know from a unit owner's perspective, there's two key coverages that you want to think about here is as an owner of an association unit. Number one, that's your loss assessment coverage. And number two, that's your additional living expenses. So on the H06 policy, which is the condo unit owner policy, you do have a specific coverage limit for loss assessment. So think of a situation where, let's just think about hurricanes and your hurricane deductible. On a standard property policy in Florida, your hurricane deductible is a percentage of the overall building value. So in this case, let's say it's a hurricane and not a building collapse. A standard deductible is 5% of the building value. So if you have a situation where there is a storm, it damages the building, and your deductible is 5% of the building value, at 30 million, you're talking about $150,000 that the association would be responsible for. If you don't have a deductible reserve or a general insurance reserve fund, which 90% of associations don't, let me take that back. If you have one, 90% of associations don't have it fully funded. The association is going to levy an assessment against the membership to pay the out-of-pocket expense that is associated with your deductible. If you have an HO6 policy and you have the loss assessment coverage, then whatever your limit is for that, you can file the claim with your personal insurance carrier, and they would pay to pay that assessment. So your standard limits are, I think 1,000 to 10,000. You might be able to purchase more. I don't really know, honestly, because I don't do a lot with the HO6 policies. The other coverage feature that you're looking at from the HO6 is your additional living expense. So if something happens and you're not able to live in your condo, there's policy limits, daily per diem that gives you reimbursement for, hotel and additional living expenses. Those are the two things that you're looking at on the HO6 policy. And then obviously you want to make sure that you have adequate limits for any additions, alterations that you do to your unit, because the HO6 policy in general terms is paying for the interior components that aren't drywall out. So if the association as originally built had carpet in the floors and you put in hardwood, you need to make sure that you account for the additional cost of the hardwood. So what I can say from the personal insurance perspective, and this is what I say to everyone, is consult with your personal agent and make sure that your limits are adequate based off of the association's policy and what you do on your unit as far as any updates or changes that you make.
Yeah, it's always good to make sure everybody has a copy of your bylaw so they know what portion you're responsible for. Okay, let's turn back to liability now.
So Florida, I think, is ranked 47th out of 50th in the union in terms of litigious hellhole. That's our ranking. So you can't drive down the highway without seeing a billboard for an attorney that says we're not going to sue you, we're going to sue your insurance company. There's a term called social inflation. Basically, social inflation on the industry side of things means that any claim that is ultimately settled in a jury is going to be at a higher cost, because there's certain politicians and there's a certain understanding that people, when you sue an insurance company, there's endless pockets and there's going to be no additional harm to anyone else. There's a negative perspective of insurance companies, and some of it is rightly attributed. Other is a little bit exacerbated by people that are trying to make a living off of suing insurance companies. So from the liability perspective, here's what we know in terms of the Surfside collapse specifically. There's 18 million in total liability limits. So when it comes to insuring condo associations, you have a general liability policy. So your standard limits are 1 million occurrence, 2 million aggregate. So what that means is any one claim, you have up to $1 million in coverage during the course of a policy period. If you have multiple claims, you have up to $2 million in aggregate over the course of the policy period. On the D&O front, it's directors and officers liability. What protects the board and the decisions they make as they're guiding the ship? Your standard limit is $1 million and it's a $1,000 deductible. Traditionally, you don't have a deductible on the GL policy unless you've had a poor claims history. Then you might institute a deductible to try to reduce your cost. Then you have an umbrella or excess liability policy. Surfside had a $15 million limit. So here's what we know. The Surfside general liability carrier, they've already come out and said, we're going to pay the full 2 million aggregate limits. From an insurance perspective, they're setting a precedent, and I'm not going to go down this rabbit hole because it's kind of an insurance nerd thing, but essentially what they're saying is all of the deaths are each an occurrence, not the condo collapse specifically.
Really?
So by paying the $2 million aggregate limit, they're saying that the multiple litigation suits that are going to come in from each one of the owners or each one of the families is going to be defined as an occurrence, not the collapse specifically. In a traditional sense, you would think that the collapse itself would be the occurrence and the $1 million limit would apply. But from a PR perspective, the general liability company doesn't want any negative news. So they're just saying, we're going to write the $2 million check and we're going to be done with it. Here's where it gets interesting. $15 million from the excess side of things. A judge has already stated that this is not going to be nearly enough insurance to rectify the issues at hand. The excess liability company, they haven't come out explicitly and stated one way or another what they intend to do. But from my perspective, it would be, once again, just like the property side of things, the reputational harm that may come of it by trying to deny the claim or trying not to pay the claim under the guise of gross negligence because the association knew what they needed to do and chose not to do it. I think the reputational damage would be more harmful, and the cost to litigate, the claims that come in by trying to deny it would probably amount to near, if not all, of what their total cost would be if they just wrote the check. That's my opinion. What they choose to do, I don't know yet. So let's just assume that they end up paying full policy limits. So 15 million, so that's $17 million right there. A creative attorney is going to file a breach of fiduciary claim against the association. Traditionally a D&O policy is not designed to cover claims that arise where property damage or personal injury is involved. But once again, the reason why our insurance policies are as long as they are, I always get complaints about how long these insurance policies are. Well, the reason why they continue to grow in size and additional wording is added is because the intent of the policy has always been confronted or addressed by an attorney who can be creative with the suit or with the allegation. In this instance, I think it would be rightly addressed to where some attorney and someone is going to essentially file a breach of fiduciary duty claim. I don't think the D&O carrier is going to fully fight it. I think they're going to cut the $1 million check and they're going to be done with it.
Yeah.
So from a liability perspective, we're talking about $18 million, which isn't going to be nearly enough to cover the loss of life and just the sheer terror that this event caused. So what else is going to happen? You mentioned earlier, any service provider or any service contractor that's been at the property over the course of its entire existence is going to be brought into the fray.
It's a legal nightmare.
It's a legal nightmare. So what we do know, so the engineering firm that put together the reports has already had a lawsuit filed against it. The city of Surfside has already got a lawsuit filed against it. What I don't know is whether or not there's a property management company involved or if it was a self-managed association. If the property,
and let's reiterate what you just said there. Did they employ their own licensed community association manager, or did they utilize through a management firm?
Yeah. So the way
they did have a manager.
Oh, they did have a manager.
They do have a manager. Yeah.
Okay. So the way associations are managed are the board either manages themselves. So the board of directors, they make the decisions as the operating managers. They self-employ a property manager, so it's a direct employee of the association, or you hire a third-party management company. If there's a third-party management company involved, you can rest assured that they're going to have a lawsuit filed against them. And the insurance agent, you can rest assured they're going to have a lawsuit filed against that insurance agent. They're going to allege that the insurance agent didn't provide them enough policy limits.
Really?
The way that the insurance company or the insurance agent will deny the claim is by proving rejection of coverage, or you've offered the coverages and they chose not to accept it. From my side of things, if we offer a coverage and the association chooses not to carry that coverage, let's say an umbrella policy or an excess liability policy, it's not a state mandated coverage. Not every association carries one. If they choose not to carry one, then we make them sign a coverage rejection form. Where I think that this is going to be battled out in court if the association's agent did in fact offer them an excess liability policy, which we know they did because they purchased a $15 million limit. What I see happening is some attorney coming back and saying, well, you should have offered them a higher limit, or you should have given them the opportunity to purchase a higher limit. So if the association's agent didn't properly document their ability or their willingness to offer a higher limit, and the association's choosing or rejection of that higher limit, I think the insurance agent's E&O is going to be exposed. So their errors and omissions coverage is going to be exposed. So what we know, the professional liability for the engineering firm is going to be exposed. I'm almost certain at some point the errors and omissions policy for the insurance agent is going to be exposed. And if in fact there was a third-party property management company, you can rest assured that their professional liability is going to be exposed. Whether or not you feel that's right or justified, it's just going to be the case because it's such a highly publicized and such a tragic event. Now, what does that mean for us as service providers, especially property management entities? If you, the property management company or the property manager, know that there's issues and know there's things that need to be done or need to be addressed at the association, and they're not being addressed, outside of that being recorded in the board meeting minutes, you're going to have to start putting waivers of liability together. And I'll leave the depths of this to the attorney when you get them or an engineering firm involved with, the additional discussion. But, everyone that now works with community associations is going to have to go above and beyond to cover your rear end. If you're making recommendations or you're doing things that are trying to better the association, and the board is willingly going against those recommendations, or not taking those recommendations to heart, then you're going to have to properly document that these recommendations have been made, or you could theoretically be exposed on the back end. So I was talking to a property manager the other day, and he goes, at this point, anytime I have a structural issue or an engineering firm comes out, or we have any deferred maintenance, I'm going to make the recommendation. My attorney's putting together a waiver of liability for those recommendations, a standard form, and they're going to make the board sign the waiver of liability for any future incident that may arise out of them not taking that recommendation.
Not only that, Robert, can you see every time somebody hands over some kind of documentation to the board members, they're going to say, I need you to sign that you've received this, so that they can say, we did notify you of this, whether you're a management firm, a service provider, or an attorney. I mean, I could just totally see them. Be prepared, board members. You're going to be signing a lot of stuff. And
Oh yeah.
once you take control of it, this is probably a good time. We'll kind of go out a little bit, but okay. There's a lot of D&O policies out there. There's some really good ones. And so let's say the president signs off that he's received something, and then something goes down, a claim occurs, and the secretary treasurer says, yeah, but I was never informed of it. Do you want to just touch really quickly on how the good D&O policies out there separate the liability for the board members?
Yeah, so the D&O policy essentially protects the personal assets of the association board members. If there wasn't a D&O policy, then you wouldn't have any volunteers to run a condo board. Not all D&O policies are created equally. What I'll just simply say is consult with your insurance agent and discuss the different scenarios with your agent about what your specific D&O policy covers and doesn't cover. But there's exclusions and provisions that can lead to more first dollar cost or out-of-pocket expenses. One off the top of my head is failure to maintain proper insurance. The gist of it, they're not all created equal. So discuss with your agent, what the right policy is for you. What I can say about all liability insurance for condo associations, it's going to get difficult to obtain. And what's been going on over the course of the last 3 to 5 years, most associations don't realize it because the increases in comparison to the property insurance are minimal. But from a percentage standpoint, liability rates have been going up 10 to 20% each year. And the carriers that used to do the GL insurance are starting to remove themselves from the market. So there used to be an abundance of companies that were willing to write condo GL insurance in the state of Florida. But over the course of the last 3 to 5 years, a lot of the companies have pulled out of the marketplace. And it goes back to the fact that the litigious environment in Florida is such that associations are facing increased lawsuits, and the judgments against them are at a higher level. And so what we have left is we have about, let's say 3 standard companies, 3 to 5, so to speak, standard general liability insurance companies, only 1 or 2 of which are admitted companies. If your loss history doesn't allow you, or your underwriting and risk profile doesn't allow you access to one of those companies, then you have to go to a secondary market. Those secondary markets are riddled with exclusions, and the price is about double, or at least 1.5 times, if not double, what you're going to be paying under one of the standard markets. Then you're going to be facing exclusions where you have assault and battery, firearms not covered, contract work performed by contractors not covered. It's already been difficult from a liability perspective, but like I said, not many associations fully understood the depths of the issues because they're solely focused on the cost of the property insurance or the flood insurance, because that's where the majority of the premium is going. What we're going to see now is we're going to see what is left in the general liability market tighten up even more. So associations that are older than a certain age, that are higher than a certain number of stories, aren't going to have access to certain insurance markets. Higher rentals, short-term rentals, higher percentage of rentals, you're not going to have access to certain insurance markets. The insurance markets that are left to insure higher, higher storied, older coastal structures, they're going to put more scrutiny on the insurance, or I'm sorry, on the association and on their willingness to properly maintain the building. Like we discussed before, we're going to need to see engineering reports. We're going to need to see the last time anything structural was done. What's the last time you did anything to the building? When did you replace the water lines? When did you replace the electrical? When did you replace the roof? All of these questions are going to be asked. They're already asked now, but they're not as scrutinized. Now they're going to be much more scrutinized. And like I said before, one of our markets has already requested 1 year's worth of board meeting minutes so they can review them and see if there's any issues that would be pertaining to structural integrity or anything that needed to be addressed to the building. Have they been discussed? If they've been discussed, have they been addressed? And if they haven't been addressed, why haven't they been addressed? So that would potentially lead to less market access or less market availability. And so what we're going to see now is we're going to see the rates for general liability insurance go up. Directors and officers liability, it's typically one of the cheaper coverages that associations purchase. It's been criminally underpriced for a number of years. We're going to see the D&O rates start to rise on a fairly significant basis, and the excess liability policies. If you've got a relatively clean loss history, then the excess liability has been extremely cheap for associations over the years. What we're seeing in the excess liability market outside of condos is that the premiums have been increasing tenfold, in some instances 100 to 200%. We haven't seen that impact on the excess liability policies just yet. With this condo collapse, I think we're going to start to see, fairly significant rate increases on the excess liability side as well. So, what we can expect is, a reduction of capacity, a reduction of availability of coverage, and what's left is the cost is going to go up. And so what we can recommend is now more than ever, you have to be proactive when you're managing an association.
It's just another reason why you should have a manager. This type of thing, if it was self-managed, it would be, they'd be throwing their hands up. It might turn into where some of these liability carriers are going to say, we're not going to insure you unless you have a licensed manager on staff or that you contract out to one, because that would make sense. There's too many self-managed associations that they just don't know. And that's kind of why we do these video segments, to help you guys. And there's a lot of different ways that you can hire an association manager, a licensed association manager. And so don't just say that you can't afford it until you've checked into the different ways that they can assist you with that. So I'm just going to plug that a little bit. Okay, so I want to talk really quickly about how, how when I know you don't do a lot of the construction industry, but a lot in the construction industry, many of them do have a $15 million umbrella. A lot of them can't even get involved with some of these buildings of certain heights unless they have a minimum of 5 million and up. You think about how, when you say 1 million liability, I've heard people say in the past, well, I've got a whole $1 million liability. In a situation like this, how that's like pennies,
Yeah.
And I wonder, just from an insurance perspective, I'm thinking, okay, let's say these attorneys, I'm not going to say anything negative. I was going to say something. I'm not going to say anything bad, but okay, let's say these attorneys, they start pulling everybody that's ever been on the site.
Yep.
This guy was over here. Because remember, there's a pool guy that took some pictures, right? Not, I think like a couple, like within a month of when this actually occurred. So
Yep.
he was on site and he had taken some photos. And so I was thinking, they're going to pull him in and they're going to ask him, well, his liability insurance is going to have to defend him in this instance. He's probably done nothing wrong. You know what I mean? It's like all of these policies are going to be affected now. So I can imagine that on the construction industry side too, this is just going to hit them hard, even harder than norm. There's a couple of people on YouTube that have done some really crappy, excuse my language, stuff on this whole scenario because they just want to get views, and it's sad. But there's a couple of engineers that have been on that are talking, and they've actually pulled up some plans and they've talked about different scenarios and this and that, and they've been gathering information. And There was one who did point something out that I thought was interesting, and it looked like some of the pylons on that side of the building that collapsed were smaller than the pylons that were used on the other side that stayed. So if that's true, it could go into a construction thing.
Well, we can go down a rabbit hole of conspiracy
Yeah.
theory and what happened, but what I think ultimately happened is we saw a perfect storm in this specific scenario where the origins of the building were potentially compromised. Over the years, the environmental factors that impacted the structural integrity of the building, in conjunction with the association's failure to proactively maintain the building, led to this scenario. Now, what we do know is that this is not an everyday occurrence. This is not something that I think association boards and managers should be fearful of happening to them, but it should be a wake-up call to everyone that the business that we're in is a very serious business, and it's something that we all have to take very seriously. So we can't overlook what are seemingly minor things, because minor things traditionally lead to much more impactful things. It's the snowball effect.
Mm-hmm.
The snowball starts at the top of the hill as a very small minor event. By the end of it, it's a giant, it's a giant ball engulfing everything in its path. And so the state of Florida, as a result of this, is going to react, potentially overreact, in terms of how residential buildings are governed.
They've already been pulling people. They've already been evacuating buildings.
They're evacuating buildings. They're pulling permits. I think we're going to see cities act before the state acts. And so different cities are going to pass different guidance on how buildings should be governed. But what I'm starting to see is, buildings that are over a certain year, I guess as it stands right now, buildings are due to be inspected every 10 years. What I'm starting to see is a lot of cities are going to look at doing inspections every 2 years. And so it's going to be something that, you're going to be having to constantly monitor moving forward, especially for older buildings and older associations.
Document. If you're a board, make your document everything. There was a question I was going to ask you, though, that was kind of leading. I really do. I want to get Nikki on here. I can't get Becker on here because they actually were the attorneys on this case. And
Yep.
so I was going to get Nikki at Appleton Reese to come in and try to us throw around some stuff. I just feel like this is the whole, again, it goes back to if you're going to be on a board, you're putting yourself out there. So make sure your D&O is in place, your D&O liability is in place. If you get on a board and there's no directors and officers liability, resign from the board. If you are on a board, treat it like it's a business, because technically, you're playing with other people's money. I used to say you're playing with other people's money and investments. Now
Yep.
you're playing with other people's money and investments and lives if you're
Yep.
dealing in a high-rise condo association.
Yep.
But you really do. You need some kind of consultant. If you don't hire a manager full time, then you need to at least have a management consultant come out and help your board. It's probably cheaper to hire a manager. But what board members have to remember is these guys take ongoing education courses, and every year they have to do the legal updates, and they have to understand all the laws that go on. And this is where it's going to help you as an association. There's no way for you to know all this. It's not what you get paid to do. It's what the managers get paid to do. So just take that to heart and consider that. I forgot what I was going to say, but
Well, I'll just piggyback on that and say there's unlimited resources nowadays for property managers, and the good managers that are out there, they're taking advantage of the resources available to them to educate themselves on every aspect of community association management. Whether it's BMI here or vendors putting specific lunch and learn groups together. The value of a good property manager in a lot of senses is priceless. So what I recommend to any association board is do your diligence, find a manager that works well with you, and then utilize that manager to your abilities.
And don't search for a manager based on Google reviews. Search for a manager based upon recommendation letters that you've received from other associations. They all have recommendation letters. Ask them for them. Ignore online reviews. They're
Well,
worthless.
the Google reviews are always from tenants that have no interest in the association and are generally just upset at the world.
Yeah,
Uh, so yes, the best way to hire a management entity is to get one through recommendation or organizations like BMI to put you in touch with certain management companies, because uh, like everything, management companies are different. They have different service platforms and they're better for different types of associations. So it's not a one size fit all. Uh, like I say, when you're hiring an insurance agent, an attorney, an accountant, same holds true for a property management company. Identify the needs and wants of the association, prioritize them, and then interview your service providers or your professional service providers and find the one that best fits your needs and wants for the association, and don't do it based off of price. Because if you cut a few dollars up on the front end, it's always going to end up that you're paying more on the back end.
mhm,
And that can't be stressed enough. And what I hope we all take out of this is that the value of good, solid professional services is tenfold. And it was a lot like the 11 years spread that we didn't have a storm in Florida. Boards and associations didn't fully realize the impact of a good insurance policy and what it meant to have an out-of-pocket expense or a deductible. It takes a tragedy or it takes a severe catastrophic event for people to understand the importance of good, solid, professional advice and professional service. And
right,
that's what I hope we can take away from this.
yeah,
On my end, from a recommendation perspective on the insurance side of things, if you're a condo association, and it's hard right now because insurance costs are going up so much uh, because of the market environment, this obviously isn't going to help anything. If you're a condo association, state statute only require you get an appraisal done every 36 months. My recommendation is do one every year. That way you're insuring to the most current value. And if you do have a catastrophic loss, there's not going to be a potential deviation between what coverage limit is paid out and what limit is actually needed to fully replace the association's buildings, because any coverage discrepancy or any discrepancy in cost could be a liability for the association. You could have membership that don't want to do the special assessment or don't want to pay the assessment. They could file a claim against the association for breach of fiduciary duty. With the way that construction costs are constantly changing, and especially right now with inflation, I'm highly recommending that, especially high-rise associations and higher valued associations, you get an appraisal every year and insure to the appraised value every year. Obviously, the confines of our budget may restrict our ability to do that or restrict our want to do that. But just remember, what the potential scenario is, like Surfside. Just apply that to a catastrophic storm. If the building's completely destroyed, just like the judge said in Surfside, there's not enough coverage available to what's left. You want to make sure that you have adequate limits or the most current limits available. And then also, if you don't have an excess liability policy, you don't have an umbrella policy, purchase one now, especially if you have any type of liability exposure, swimming pool, playgrounds, common areas where kids or people get together. If you have roads or signs, anything, just playgrounds. If you don't have an excess liability policy, buy one now. Like we were talking about earlier, $1 million sounds like a lot of money, but $1 million in today's era is not a lot of money. If you have an excess liability policy, specifically if you're a high rise, look at buying additional limits now while it's still relatively affordable. So if you have 10 million, look at 25 million. The majority of the programs that are available to associations for excess or umbrella liability, offer upwards of $50 million worth of coverage for a relatively reasonable price. Sincerely look at what your limits are. If you don't have one, buy one, buy limits. If you have limits, look at potentially increasing those limits for the foreseeable future. As it pertains to the insurance from your service providers, if you're not demanding certificates of insurance for anyone to be on the property doing work consistently, demand those certificates of insurance. if you have a certificate of insurance and you have a project that's going on and the insurance is renewing for that service provider during the course of your project or during the course of your contract, note the date that it's renewing and then demand an updated proof of insurance once that, once that date arrives. If you're doing a major construction project or any type of major project, let's just say at the property, scrutinize what limits are being purchased by the service provider. Now more than ever, you need to document, like Carrie was saying, and the standard protocols or the SOP for an association service providers is they're not allowed on the property without adequate insurance or proof of insurance.
And don't forget that service contractors can forget to pay their policies, whatever the reason, and those policies can lapse. And if you're a certificate holder, the agent, the insurance company, they're supposed to send you a list or a new updated certificate of when it's canceled. I don't know if all that holds up in a court of law, but the point is that you need to stay on top of it. If somebody's been there for 6 months and you've had an insurance certificate in your hand for 6 months, go ahead every 6 months, update it. I know it's a lot of work, but if something happens, you don't want it to fall back on the association.
And one final note, if it's not written into the bylaws already, and obviously this is a tough one to enforce, but you give yourself some legal standing, and I'll defer, the legal intricacies to an attorney. But if you don't have it written in the bylaws already, talk to your attorney about revising the bylaws to mandate the unit owners purchase an HO6 policy on the interior components of their units. Because if you have a situation where there's a catastrophic event and the association is going to rebuild the buildings, if there's not coverage for that unit, let's say they own the unit outright, they decided not to purchase insurance, they decide they're not going to pay for their portion of the unit, you're going to be paying that out of pocket. If you have it written within the bylaws that you're required to carry an HO6 policy on your unit, then at least you have legal footing to go after the individual for not maintaining that, and it gives you a leg up. And so it's hard to enforce unless you have an administrator who carries proof of coverage and is actively monitoring the proof of coverage. But if it's not in the bylaws, I highly recommend that you talk to an attorney about revising the bylaws to at least put the mandate in there, and then it gives you a legal standing in the event that you do have a claim.
Yes, thank you. Robert, I just remembered what I was going to say. The media has now gotten onto the topic of condo associations in Florida. Yep. So just the other day, I was on doing our Facebook post, and I see that the news popped up, and there was a flood at an apartment community. Now, it's probably one individual unit that had a flood, but this particular apartment community was several stories high. Mm-hmm. So it automatically goes on Facebook. Oh, what are they going to do? How's this going to affect the building's structural integrity and da da da? And so, I mean, just think of it from the standpoint, we are under they're going to be on watch for us, the eagle eye. They're going to be anything that happens in a community that could possibly be newsworthy. If it wasn't before, it is now. So just be really cautious of that. Be careful what you say on the news to any board members. I think from a legal I'm not an attorney. I don't play one on TV, and I didn't eat my Wheaties this morning. But I will tell you that if news wants to speak with you, you're probably better off saying, you know what, we'll let you talk to the manager of our association. Stay out of it.
Yeah. A lot of battles nowadays are fought in the court of public opinion, and the media narrative can either work in your favor or work against you. Mm-hmm. So anytime that there's a situation where a claim occurs, or there's even the potential for litigation, it's highly recommended that all discussions are internal, and consult with your association's attorney before anything is discussed or released, because anything that is out there can be used against you in the court of law, so to speak.
Yeah. If any of you board members out there are looking for reputable community associations, and you're looking for referrals and whatnot, you can always reach out. There's plenty of resources. There's BMI Tampa Bay. There's c.a.i has resources. If you work with service vendors like Robert, who focuses solely on the community association world, he's going to be able to put you in touch with the right people. So don't be scared to reach out and at least find out the pricing on getting away from self-managing, because it is really dangerous. And Robert, thank you so much for taking your time to do this today. We went more than 45 minutes, but hey, we did hold it down to an hour, so I'm really proud of that.
Yeah, well, and just to kind of summarize, the impact of this is going to be constantly evolving and long lasting. Initially, it's going to be more difficult to purchase good insurance for a reasonable price in Florida for the time being. That was already the case because of our issues with hurricanes, and like we were discussing, litigation that the carriers are facing. This just adds another dynamic to it. More than ever, just kind of echoing what Carrie said, consult your trusted service providers. Can't express that enough. Sit down, have discussions with them, and put plans together for areas of concerns or issues that you have. You know, right after the collapse, a lot of my association boards called me or emailed me like, hey, we have cracking in the building, or we have this going on, we have that going on. And my answer to them in most of these instances is probably not going to be an insurance thing. You need to really just get a contractor out there to look at it, or an engineer to look at it, to see if it's a structural issue or if it's just an aesthetic issue. Now more than ever, you got to lean on your professionals.
All right. Well, thank you, Robert. Thank you for your time. And if you guys need to get in touch with Robert, I'll have his contact information put at the end of this video.
Great. Thank you.